What's up, everyone? It's Eric with Option Edge, and today I'm going over a little education. We're talking about bull call spreads and what exactly is a bull call spread. Okay, so I got a little PowerPoint. Let's bring that up. Bull call spreads. Bull call spreads. Okay, so the reason why I'm talking about this is because when I first started playing with options, I didn't understand what a bull call spread was, what a bull credit spread was, what a bear credit spread was, what a bear debit spread was, what a put debit spread, a put credit spread is. So there's a lot of different combinations, and it was very confusing at first. So today we're just going to simply talk about what is a bull call spread. Okay, so another name for a bull call spread is a call debit spread, okay, equals bull call spread. And the reason why it's called a bull call spread is because you are net long, you are bullish. If you have a bull call spread on in a particular stock, that's your option strategy for a particular stock, then you believe the stock will go up, okay? So let's talk a little bit more about this. So when you're starting with a bull call spread, it's two options. You're going to buy a call and you're going to sell a call. So the call that you're buying, that you're long, is going to be closer to the money or longer dated compared to the call you're selling. It has more value. The call that you're selling is either more out of the money or shorter dated. It has less value. What happens when you take something that has more value and subtract it by something that has less value? Well, you get a positive number. So anytime, let's look at the pricing. So when basically the call that you long and the call that you short will subtract each other to give you a net debit. Okay, a debit means you're long. If it was a negative number, that would be a credit. That would mean you're short. Okay. So the short call will subtract its value from the long call. Overall, the option strategy is a net debit as opposed to a credit. This is a long position. Okay, and here's the formula. Long call price minus short call price gives you the bull call spread value, or the call debit spread value as well. Same thing. Bull call spread, call debit spread, same thing. So let's go to the options chain just to show you. So I have NVIDIA up here, stock I've been talking about for a little bit lately as it's dropped. But let's say, so NVIDIA just dropped a bunch. Let's say you think NVIDIA is going to go up, but you don't have that much money and you don't want to take on that much risk. So instead of just YOLOing and buying a $4,000 call, so let's set this to buy. Instead of buying this, we're going to set up a bull call spread or a call debit spread. So first step is let's say you like the 725 strike, you're going to buy that. Okay, so you select buy. Then we're going to sell a call against it. Okay, sell a call against it. And what was the criteria? It's got to be less value than the call you bought. So let's do this 730. So you see, you have the value of the call we're longing minus, and even Robin even shows you, subtracts the call we sold, okay? And look at our total. That's a debit, okay? That's our total. So $202.42 times 100, 242 is the most money we can lose. And let's look at the expected profit and loss graph. It says 243 for some reason. I'm not sure why, but that's the most money we can lose here. The debit paid is the most money you can lose for a call debit spread. Okay, so there you have it. 725 minus 730 gives you this $2.42 position. Let's look at if we were to buy. Let's try something. If we were to sell the call underneath the 725 call, what is that going to turn into? So if we sell this one, total credit. So you see what happened here? We're selling the 720 call. So this has more value. So we're more short than we are long. So what happens is this results in a credit. Okay. So let's go back. Let's sell so we still have 725 that we're buying. Let's sell the 750. Now, as you can see, this is more out of the money. Okay, more out of the money. So since it's more out of the money, our net debit is more. We can lose more, but our exposure to in Nvidia is now more. Okay, because we went further out of the money, and I can demonstrate sort of how this works. So let me go back to our little slideshow. We talked about this right here, the example. We bought the 725 call for 40, sold it for $37.58, net debit of $2.42. Okay. But going back, let's talk about delta. Okay. So if we look at the first example, our net delta was about $2, or excuse me, a value of 2, which one delta is like owning one share of stock. So in this case, it's like we're owning 2 shares of stock, and the delta of the long call was 53, and the delta of the short call was 51. And let's look at the option chain. So let's go back. So let's look at the Greeks here. You can see our delta 53, and then we come back and we want to sell this call, the 730. That delta is 51. So you subtract them, you get 2. That gives you your net delta. So your delta is your directional exposure. Okay. So like I said before, if the stock goes up, it will. If Nvidia goes up, us owning this call option will act like owning 2 shares of stock. Okay, in a way. And the way we can show delta exposure is we're going to sell something more out of the money. Let's go back to that 750 call. Let's look at our delta, 43. Okay. If you remember, 725 had a delta of 53. Now this has a delta of 43. 53 minus 43 equals 10. So the cost is more because our directional exposure is more. Okay. So now it's like we're owning 10 shares of stock. Okay. So that's it. That is what a bull call spread is. I hope that makes sense. Bull call spread is also the same as a call debit spread, because we are when you subtract the 2, you're getting a net debit. Hope this helped. Hope that makes sense. Like and subscribe if you like this stuff. Anyway, peace out. Bye.